Well, hello, everyone, and thank you for joining today's Alamo Mortgage Holdings webinar. We have an exciting presentation to share with you all. We're going to be talking about how you can earn passive income and get on an annual investment program with Alamo Mortgage Holdings. But before I go through the details of how that works, I'm going to first do a very brief disclaimer, and then we'll go through the actual fun part of the presentation. So as accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. Please read the risk statement within the investment memorandum before investing. Fantastic. Okay, very good, very good. So we're going to talk about our financial product and how you can earn 8% passive income by purchasing an Alamo Mortgage Holdings corporate income loan note or bond. So the mission of Alamo Mortgage Holdings is to provide passive income to our investors by purchasing real estate-backed mortgage notes in the United States in the state of Texas. We provide our investors and institutional partners with long-term passive income. About us, we have 200 years of business experience with 100 years in the mortgage and real estate industry. We handle all of the collections. After we purchase mortgage debt, we do all the collections. Our investors don't have to ever talk to a borrower. And we allow you to invest in multiple currencies. We also offer a 100% money back guarantee on any non-performing notes. We don't hold non-performing notes in the portfolio. As far as the investment overview, it's a fixed income loan note, and we suggest an investment of £100,000. But if you're a new investor and you're just getting started and you want to do something less than that, we can work with you. The term ranges from 3 to 50 years, and the security is a debenture over our company and all assets. So fantastic. So about the team, our team has 200 years of general business experience with over 100 years in the mortgage and real estate industry in Texas. Our team members have successfully managed or are currently managing investment funds, real estate projects worldwide, and overseen up to $1 billion in financial assets. Members of our team have also worked with clients including Microsoft, Chevron, Exxon, Eventbrite, and Fora Financial. As for myself, a few details about my background. I'm the managing director of Alamo. Prior to Alamo, I was very active. I am very active in the mortgage and real estate industry. I have also been involved in business acquisitions in the US and in Europe. I have founded several startup businesses. And I'm also the director of an emerging market bond fund, and I'm on the board of various companies throughout the world. So that's a little bit about my background. We have Marina Zahorelska. She is our international investment coordinator. She speaks 5 languages. So whatever language you want to speak, there's a good chance that she can communicate with you. She graduated from the EU Business School with a Bachelor of Arts in International Relations, and she's our international investment coordinator. We have Scott Wynn. He is an industry expert for Alamo Mortgage Holdings. Scott has more than 30 years of experience buying owner-financed real estate notes, residential and commercial loan originations, and he is a specialist in what are called junk assets. These are assets that they are no longer producing income. So maybe it's a property where the payments have stopped coming in from the borrower. He's a specialist in getting the payments to start again and doing workarounds, this sort of thing. So very, very good experience. We have Fred Hobbs. He's our director of mortgage servicing. He's been a mortgage originator licensed in the state of Texas since 2000. He's the founder and president also of Texas Mortgage Capital. He has been involved in lots of deals. He's been involved with thousands of private money residential notes. He's originated thousands of loans for seller finance investors and private investors in both residential and commercial markets. We have David Jones. David Jones is our in-house legal counsel. He's a licensed attorney in the state of Texas, and he helps us with making sure that all of the legal documents on the transactions are correct. We have Anna Kulikova. She's a specialist in investor relations, and she likes to work with investors to help them come up with a plan to build passive income. We have Mark DeRuyter. He is our chief technical officer. Mark actually is very experienced in the software industry, but within the software industry, he has been involved in a lot of the mortgage software, some commercial mortgage software. There's a possibility you may have used some software for the calculation of mortgages that he actually created or had a hand in creating. So he's very experienced and he brings a lot to the team. Okay, let's talk about the financial product. You can earn an 8% rate of return, and we'll talk about that in a minute. And why that's good. I'm going to go through why that's good. It may not sound like as much as maybe a private equity or hedge fund type thing, but there's a big advantage here with what we've got, where you are getting passive income secured by mortgage debt. So there's a 3-year, a 5-year, and a 50-year term. Now let's watch a short video clip here, and this is directed really at our friends in the UK. We have some people from the UK that are very interested in our financial products, and I certainly understand the reason why. If you look at what has happened to the US dollar and the British pound ever since Bretton Woods, the British pound has lost so much value against the dollar that, you know, a lot of people are thinking maybe they should convert their pounds to dollars. So let's talk about why do so many investors still purchase gilts for passive income. And for those of you not from the UK, a gilt is just a UK government bond. So are UK gilts still worthwhile during high inflation and a weakening British pound? Now, let me go through this here. If you're looking to purchase gilts, let's say you're looking around and you've bumped into this video and you're looking to purchase gilts, you probably are in the situation where you want a reliable way to obtain passive income, and gilts would fit this requirement. The problem with gilts, though, is they are denominated in British pounds, and the pound has a decades-long history, a tradition of losing value against the US dollar. Another problem with purchasing gilts is that the returns they offer are lower than corporate income bonds. They're always lower. Interest on all registered gilts is payable gross without deduction of tax. Holders of gilts on the register maintained by CIS may opt to have tax deducted at source by applying to CIS. Gilts, of course, have their merits, and for an investor, this is important. Gilts have their merits, and for an investor that can turn a blind eye to the high rates of inflation. So if you're the type of investor that can see all that high inflation in the United Kingdom and you can just shut your eyes, turn a blind eye and say, I don't see it, that is one of the requirements. The second requirement is if you can also, with your other eye, turn a blind eye to the weakening British pound. If you can just ignore that for decades your pound has lost value against the dollar. Ever since Bretton Woods, it's lost and weakened against the US dollar. Then if you're that type of investor, then yeah, you can accept gilts and you'll get paid on time and you'll get some passive income and it'll be great. And they're index linked and you can go to sleep and just, you turned a blind eye on both of the problems and hey, everything's good. Yet the fact that gilts are easier to purchase and more well-known does not mean you will earn as much interest. If you were to instead purchase my company, Alamo Mortgage Holdings, we offer a corporate income bond. If you were to purchase a corporate income bond through Alamo Mortgage holdings, you could potentially earn hundreds of basis points more per year on your corporate income bonds than those old gilts. If you're interested in purchasing a bond, you can contact me directly by emailing ben.miller at alamomortgageholdingsltd.co.uk or call me. I've got a US number, 1 for the United States, and then area code 817-203-4160. We can have a discussion about your passive income goals and also your investment goals. If after that discussion, the product seems suitable for your investment portfolio, you then can sign some paperwork that will be prepared based on the term of the bond you are looking for and some other features. If you currently have British pounds and you want to exchange for US dollars, that's easy to do. We simply handle the conversion for you, and then your bond is paid in dollars. At the point it is converted, you have made a dollar-denominated investment and no longer will potentially lose money on the exchange rate if the US dollar keeps rising against the British pound sterling. Fantastic. So that's how it works. That is now, one of the nice things. Now let's take an example. Here's an example here where let's say that there is a note, a mortgage debt in America of 100,000. And let's imagine that the interest rate on that mortgage debt is 10%. Okay. So that means that there is someone that owns this note, and let's say for whatever reason they need cash. Well, these notes are generally illiquid, so they might come to a company like Alamo Mortgage Holdings and they'd say, you know, I have this note, I'd like to sell it. And Alamo would say, well, you know, we can't pay you 100,000. We'll pay you 70,000. If you want to sell it for 70,000 cash, we can buy it. So let's say the seller agrees to that. Now the yield, the interest rate has stayed the same as 10%, but the yield on this hypothetical note is now at 14.2%. And that makes it quite easy for us to pay out 8% to our investors. So that is how that works. Here is, but let's talk about how does Alamo actually determine the value of a mortgage note? How does a note buyer try to figure out how much a note is worth? Well, this is a great video and covers that. So then what determines the value of mortgage debt? Because we know what determines the value of real estate. Real estate is determined by the value of a particular flat or house. It's determined by what are comparable houses and flats. What do they sell for? That determines the value. If it's a commercial property, it's determined differently, where it's determined by the cash flow on the commercial property. But for this example, if we talk about a mortgage note on, say, a property of maybe a residential home, there's 6 factors that determine the value of a mortgage note. The first factor is the buyer. So if you had a choice between buyers, say you have a property and you're trying to decide who to sell the property to, and you've got one person that is a government employee, and that government employee has a high salary. They've been working for many years for the government. Maybe they work as a post office person. Maybe they deliver packages for the post office. And they've been doing this for 10 years. If the government is their employer, you know there's a very high probability they're going to get paid on time. But if you have another buyer that says, you know, I'm 24 years old and I just started my new company, and I'm just going to make a bunch of money with my company. And they don't have a regular income, but they have a plan where they're going to make money in the future. That sort of buyer is far less desirable. It's better to sell the asset to one that has a regular government income, the government employee, or the one that works at some sort of a big corporation. Maybe they work at Microsoft. Maybe they work at Google. Maybe they work at some big corporation. That buyer is more likely to be able to pay, where they are not going to have cash flow experiences where the things are up or down. The second thing that determines the value is the collateral. So the collateral means the actual asset. So let's say that the property is worth 100,000. Say that's the market value. That's the real value, 100,000. But say that you had a seller that he sold the property with a note for 200,000. Pretend he found somebody who didn't know the prices, and that person agreed to pay 200,000, even though the market value is only 100,000. You have to treat that note differently, because the fact that he found somebody that signed a note and the asset's only worth 100, but he found someone that signed a note for 200 does not make the note worth 200. You could look at that note and you could base it on the value of the collateral. So that's a mistake, is a lot of times people don't look at the collateral, they just look at the value of the debt. And when they see the value of the debt, they may not have properly analyzed what's the collateral worth. The third factor that drives the value is the down payment, the money that the buyer initially paid. So let's say you had two buyers, one that put 30%, 40% of the purchase price, where if it was 100,000, maybe that buyer put down 30,000, 40,000, 30 or 40%. And then say another buyer said, you know what, I want to buy this. I'll pay you the 100,000, but I only have $1,000. I only can put down 1,000. Can you finance 99,000? And the seller agreed. So they both agreed to buy the asset for 100,000, but one of them put down 20,000. Another put down only 1,000. The one that put down the larger down payment is better, because there's less risk of the person saying, you know what, I don't want this. I'm just going to leave. I'm just going to move. I'm just going to, do, because he's got virtually nothing to lose. He lost $1,000, his down payment. But the one that put 20,000 or 30,000 down, he lost a lot more if he walks away from the deal. So that's why you look at the buyer's equity or their down payment or their upfront money. That's an indication of the value. So a buyer that puts down 10% is better than a buyer that puts down 1%. The fourth thing that's important is the actual interest rate. The interest rate on the note. So if you have a note, if you have a mortgage debt that pays 10% or 12%, that is better than a mortgage note that only pays 5% or 4%. So if you had a choice between two notes, two mortgage debts, and the first paid 5% and the second paid 10%, the one that paid 10% is better. The next factor that drives value is the history of the payments. So when you buy these mortgage debts, you want to look at how long has the person been making payments. You want to be careful buying a new note. You want to see a record of how long the person has been making payments. So if a person has a 30-year note, and they are 4 years into a 30-year note, where they still have 26 years left, that is safer if you see a record of payments compared to a 30-year note that the person put the down payment down, but they haven't yet made their first payment. Because what if the person just walks away? What if they don't make that payment? Then you've bought a note that is a non-performing note. You want to buy a performing note. A performing note is more valuable than a non-performing note, because then you don't have any work to do. You just buy the note, and the borrower makes payments to you. So a performing note is better, and the history of performance is important. The next factor that drives value, the sixth factor, is the actual paperwork, the legal paperwork, if it was done properly. Because if you have a note that was just two guys that were sitting around a kitchen table and they worked out a deal and they wrote it up without a lawyer, where they just wrote up an agreement and they signed it, that is less valuable because the note likely has mistakes. They're not lawyers. They just agreed that, yeah, I'll make payments to you for 30 years. Did they remember to put in any of the legal language? Did they know how to put any of the legal language in? These things are important. That type of note is less valuable than a note that had a proper closing at a legitimate company with legitimate lawyers that drafted the paperwork. Because you know that it's very likely that if you buy that note and the borrower doesn't make payments to you, you have legal recourse. You don't want to buy a note that hasn't been drafted properly, that doesn't have proper legal paperwork. So very important there. Excellent. So that's really what is important in the notes. Now let's look at it at an example here. This example is hypothetical. It's not a property that we have in our portfolio, but it shows how this type of transaction could be created. So let's imagine there's a property in Texas, and this is a real property in Sweetwater, Texas, and the sales price is $120,000. Say that the seller put the property on the market and is looking forward to getting his full price, $120,000, and nobody buys the property. No, he gets offers that come in that are $110,000, $114,000, but he's stuck on that $120,000 and he won't budge. So he meets a potential buyer, and the potential buyer comes in and says, "Hey, I love the property. I'd like to buy this. I'll pay you $20,000 down. Will you finance $100,000? And the seller says, no, hang on. I'm not a bank. Go talk to my banker. Go talk to my banker, Jim. My banker, Jim, is good. He can get you a mortgage loan, and then you come back and you just pay all of it." And the buyer says, "Okay, I will go to Jim." So he goes over to the banker, Jim. The banker, Jim, says, "Listen, I'm not going to make you a loan. You've got bad credit. You're self-employed. There's no way I'm making you a loan. Get out of my bank." So the buyer goes back to the seller and says, "I talked to Jim and he won't do it, but I've got $20,000 I can pay you now, and I'll make payments to you over time. I'll pay you the other $100,000. I'm working. I've got a company. I can do it." And the seller has a property that's vacant, that is costing him money. And he decides, you know what, I'm going to do this. So he tells the buyer, "Look, I can do it, but I'm not going to do it at a bank interest rate. You've got to pay me 10%. And the buyer says, "I'm fine with paying 10%. I'm happy to do it. I'll pay you $877.57 per month." They agree. They do the deal. Now go forward 5 years. Imagine 60 months have passed. And in that 60 months, this buyer has been perfect. He pays on time. He never makes a mistake. And as a result of that, he's made 60 payments of $877.57. So the remaining debt on the property is $96,574. That's because most of the payments are going to interest on a mortgage schedule. So now the seller, something happens in his life where he needs cash, or he wants cash. And as a result of that, he looks around and finds out that this note is illiquid, that it's not so easy to quickly sell it. And he contacts a company like Alamo Mortgage Holdings that purchases mortgage notes for cash. And in this example, we would make an offer to purchase that note. Let's say that we made an offer at a 12% yield. We might offer $83,322 to purchase this mortgage note. And as a result, that is how it works. So that's basically what happens. Now, this is for our friends in the UK. I have a chart here that shows the long-term history of the British pound against the US dollar. Back when Bretton Woods first existed, there one British pound could purchase 4 American dollars. But now look at it. Over the years, now 1 British pound purchases an American dollar, and there's nothing in that trend that is slowing down. And who knows how much further it'll go. So if you're concerned about your British pounds, converting to American dollars can be easily done by purchasing an Alamo Mortgage Holdings bond. We can handle that conversion for you. You get the listed exchange rate. We don't make any money on the exchange rate. We provide that service for free, where we will, if you purchase a bond and you say you want the bond denominated in dollars, we can do that. Or If it's the opposite, where you think that the pound is going to go and increase against the dollar, we're fine with that. Just buy your bond in pounds. Or if you're not sure, put 50% in pounds and 50% in dollars. We can work with you. So now let's take an example of what does it mean, packages of mortgage notes. Here I'm going to show here a real package of mortgage notes, so you kind of have an idea of what that looks like.
So this right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio, and you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high. 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, I mean, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance of $89,570. Maybe you try to buy it for $59,000 or $69,000. But that would be one note. But you can also purchase packages of notes, and that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes. So wanted to give you an idea of what a package of notes look like.
Excellent. Excellent. So now let's talk about why bonds. Sometimes I get this question. People say, inflation is so high right now. Why would I buy bonds? I mean, that doesn't make any sense. If inflation's high, I'm not going to buy a bond. I'm going to go buy stocks. I'm going to go buy whatever. So now let's talk about that. Rather than giving Benjamin Z. Miller's opinion, I'm going to talk about a Nobel Prize winning economist named Harry Markowitz. Harry Markowitz, he actually won the 1990 Nobel Prize for Economics for his contributions to what is now known as modern portfolio theory. And if any of you have accounts at Vanguard, at Merrill Lynch, at a lot of these companies, they design many of their portfolios and their products around this modern portfolio theory. So, but what Markowitz did was he didn't use that approach. He actually used a different approach instead of modern portfolio theory. When it came to his own personal portfolio, he kept it simple. He would put half of his money in stocks and he would put half of his money in bonds. And then once a year, he'd make an adjustment. If the stocks had gone up a great deal in value, he might sell some stocks and buy more bonds. If the stocks had gone down in value a great deal, he might sell some bonds and buy some more stocks. So that's the point. You can't know what's going to happen. And despite everybody in the world that thinks they know what's going to happen, there's a really bad record of people being able to correctly predict the future. It hasn't worked. So the point is, if you use a simple system like this, and I'm not telling you should do this, I'm saying think about your own portfolio, folks. Think about what percentage of your portfolio is in bonds. And then think about if you have most of your portfolio in British pounds, what does that mean for you? Maybe you need some currency diversification, and Alamo Mortgage Holdings has a solution for you. Okay, so why do we do this in Texas? Why don't we buy mortgage notes in New York? Why not buy mortgage notes in California? Well, folks, it's a great question. Texas is home of 49 Fortune 500 headquarters. We've got people moving into Texas all over the United States. We got people coming from New York where they've had enough of the high prices and the regulations. We've got people coming from California where they've had enough of the high prices and the business killing regulations, and they move to Texas. And when they move to Texas, they need to live somewhere, and they need a home, and they need a property, and they look at our prices in Texas and they think, wow, this is only $200,000 for a house, only $100,000 for a house, $300,000. In California, it cost me $1 million. Cost me $2 million. So they love Texas. So Texas is growing. And what happens is, as there is more demand for Texas real estate, since our collateral, the collateral that backs the Alamo Mortgage Holdings notes is real estate, the more that the collateral increases in value, driven up by the demand, as the prices of real estate go up, the better it is for Alamo Mortgage Holding, and the better it is for you as one of our bond holders, because we have our portfolio being de-risked as the collateral increases in value. What are the advantages? Well, first, folks, you can reach your passive income goals more quickly. Whether you're looking for 5,000 pounds a month in passive income, whether you're looking for 10,000 pounds a month in passive income, whether you want 100,000 pounds a month or more, Alamo Mortgage Holding can help you get there quickly as possible. We can get you on an annual investment program, and in a few years, you will be amazed at how much passive income you can build. Or if you're at a point in life where you're starting with a large capital base, where you already have a lot of capital, we can put it to work for you very quickly. We can work out a plan, and in 30 to 60 days, we can be making payments to you. We offer maximum diversification. You're not just buying one mortgage note. A lot of people, they think, oh, I'm just going to go do this. I'm just going to go buy a mortgage note. Well, good luck, and be careful with your hand on that stove. It is not so easy buying mortgage notes, and it takes some skill and it takes some knowledge. And if you don't believe me, go try it yourself. Put your hand on that stove and you will see. We also have a product that has no fees. We don't charge our investors any fees. We don't believe in that. Now, I know a lot of you may have heard the hedge fund and the private equity guys, they do their presentation for you. And, you know, I'm not saying anything bad about those guys, but they love their fees. They love their fees. You know, a lot of my friends are in that business and they just have unbelievable fees. But what they do is they get people excited where they're like, oh, you know, I'm gonna make a bunch of money, and they sign off, but they don't advertise very loudly that in private equity, 1/3 of the deals lose money, 1/3 of the deals break even. So you've got a 2/3 chance of losing money or breaking even if you if you invest in private equity. But if you do Alamo Mortgage Holdings, we are in a totally different category. You'll be getting passive income, and that 8% looks so much better than all of the people that were in their tech company and they got burned, and all the people that were in their cryptocurrency and they got burned. There's fires all over. But if you go to Alamo Mortgage Holding, you're getting paid. So that's a big advantage. And that 8% looks a world better compared to a 50% or a 100% loss. Okay, so how is it calculated? It's very simple. 100,000, 8,000 pounds a year. Do it for 5 years, you're going to earn 40,000 pounds. Do it for 50 years, you're going to earn 400,000 pounds. That's how it works. No problem. We pay you. Why should you invest in the notes? Well, this is a product that if you want an above average return, if you're the type of person that wants an above average return, this will work for you. If you want the security of something that's asset-based, if you prefer asset-based products instead of just promise-based products. And if you're looking for passive income, the term, 3 years, 5 years, 50 years. Can you put the note into your self-invested personal pension? Yes, subject to the approval by the sipp provider. What type of investment is it? It is a UK corporate income bond. Is it a regulated product? No, we're not a regulated product. That is part of the reason that we can pay so much more. We haven't had to go through the additional expense of regulation, so we can pay our bondholders more. Okay, who can invest? You've got to be one of these. You've got to be over 18. You could be a trust. You could be a company. You could even be a charity. you know, that is who can invest. How's the money protected? We have a variety of things we do on that. We can have a one-on-one discussion with you at some point if you're curious. Can I invest through a company and are joint applications permitted? Yes. How is a loan note different from a government note? Well, I mean, the government's guaranteeing their note. They've got a 0% default risk, but they pay you damn near a 0% interest rate. I mean, not 0%. It's probably, I think right now a 30-year gilt is paying 3.7%. So, okay, very good. How's the tax managed? We pay all of the tax to you. We pay all the tax to you. We don't take anything out of it. We just send all of the money to your bank, and then you and your tax professional can decide how much tax you will pay. Because, you know, everybody has a different marginal tax rate. We just pay it all to you. Are there any limits on how much I can invest? No, we're set up for large placements. We can work with institutional investors that may have millions that they're looking to place. We also can work with individual investors where they've got 100,000 pounds, or maybe they've got a bit less than that. We can work with you, whatever you want to do. Can you get access to the money early? No. And frankly, folks, for a lot of people, that's a benefit. And let me tell you why. A lot of people, they end up in this day trading thing where they're, oh, you know, the chart went up, the stock went down. I'm going to sell it real quick at a loss. I'm going to get out before it falls faster. This is, they have done studies that sort of schizophrenic, bipolar day trading thing. It really doesn't generate any long-term wealth. You know, you have a hard time finding a wealthy day trader. I'm not saying there's not one out there, but I'm just saying you are making it hard on yourself if you try that game. But with this, you don't have to stress about it. It's not going to move around like a real liquid product. You're getting 8%. You can sleep and you can know that your money's working for you. How will I receive the interest? We pay it to the bank account that you nominate. How do I find out more? Go to alamomortgageholdings.co.uk, fill out our contact form. Send me an email, ben.miller at alamomortgageholdings.co.uk. Give me a call. I have a US number +1 for the United States, 817-203-4160. So that is it for our presentation today, folks. Thank you all for coming. I'm going to stop the recording, and now I will be happy to answer any questions if anyone has any questions.